Hi everyone, this is Susan Patrick with Stand on This, and welcome to our March virtual Vision Vantagepoint user group meeting. We are so happy that you've joined us today. We are going to start as normal with some housekeeping items. So most of you have probably been in one of our webinars where we use GoToWebinar, but just as a reminder, we always get a lot of people signed up, so everybody is muted upon entry. If you can hear me now, that's fantastic. If at some point during the meeting you lose audio, sometimes you just need to call back in. I don't know what happens with technology, but y'all get it. Sometimes it just messes with us. So anyway, we do have great topics today. The handout is available under the handout section, so make sure that you check that out and get that. And again, as always, any questions that you have pertaining to the topics today, please put that question in the questions panel. Please don't put it in chat. We don't monitor chat, we monitor the questions. We will answer any questions that we can while we are presenting today. If by any chance we don't get to your question during the meeting, we will make sure that we do follow up with an email. So don't worry if you have to leave or if we didn't get your question answered. I guarantee you that the folks here today will get back to you. So again, I'm Susan Patrick. I'm so happy to have some colleagues here today joining me. I'm not here by myself, talking to myself, but we have Tom and Kelly on board. Tom and Kelly are going to walk through the R&D tax credit side of things. And then lucky you all, I will wrap things up with some Vision Vantagepoint pointers pertaining to setting up and optimizing your system for the tax credit. So again, I'm going to kick things off with some news and events coming up. We'll get into the fun stuff with the R&D tax credit. I have to say that by preparing for today, I've learned a little bit myself. And we'll walk into some timekeeping best practices and then move into optimizing your system for better R&D tax credit results. Again, put any questions in that questions panel. And the big thing for me, I really appreciate it if you fill out the survey that pops up when you leave the meeting. That gives me an idea of, first of all, how we're doing today. That's really invaluable information, as well as things maybe we can help you out with or future topic ideas. It's always great to hear from you guys as to what you're looking for in these meetings. Our next meeting is April 20th. So by then, hopefully spring will truly be here, or might be just teasing us like it is right now. And by then you should all either have filed your extension or have your taxes in, so we could all have maybe a little bit of fun in our April meeting. Couple webinars coming up. We have our own Christy Warbach presenting on March 17th, which is tomorrow, on some FMLA, ADA, workers' comp type items. So again, another don't miss webinar from our team. And then on the 23rd in a week, we have our team presenting on SALT. So that's, again, something that you want to check out, sign up for. Our team, the depth of knowledge that our team has just blows me away. So please make sure you're taking advantage of that. We're here to help support you and help you all be successful. As we talk about just some housekeeping items pertaining to the move to Vantagepoint, so those of you that are not yet on Vantagepoint, well, my slides are advancing out of control. Let me go back. There is a CAP session in session right now, but there's another one coming up in April. And then we have the dates for Deltek Cloud clients that are looking to do their Vision to Vantagepoint upgrade. And then as a reminder, we're here at the beginning of the year. So the Deltek Town Halls, I must have an advance on there. The Deltek Town Halls are published up on Deltek's website for both Vision Vantagepoint and their other products. So please make sure that you're checking that out and getting signed up for the ones that are of interest to you. And I know I went through that really, really quickly today, but I could not wait to be able to turn things over to Tom and Kelly to talk about the R&D tax credit. So as we kind of transition to them, the first thing that we're going to do is we're going to pull up a polling question. So have you previously taken the R&D tax credit? Yes, or you're working on it right now? No, or maybe you tried before, but you didn't qualify. And then maybe some of you aren't really sure exactly what that is. So as I'm looking at the polling coming through, we got a little over almost 60% or more voting. This is interesting and helpful for both Tom and Kelly as we look at your the results here. I think here we'll be able to present them in a minute. We're looking about 51% yes. A small percentage are working on it now. We got about 30% saying no and 12%. Here you go, Tom and Kelly. You're able to educate about 12% of our audience today. So there are the results. And I'm going to go ahead and put myself on mute and let you guys take it away. So thank you, Tom and Kelly.
Okay, well, thank you very much, Susan. Kelly and I are pleased to be with the group here today to talk a little bit about the R&D credit. Hopefully for those of you that have been taking it, maybe you'll pick up a pointer or two that can enhance your credit further. And for those of you that aren't taking the credit, hopefully you'll learn something today that maybe inspires you to look a little bit deeper into the credit. And to that end, we thought we would start today here just by sharing just a couple of success stories that we've had with clients that we've worked with over the years. And we just want to give you a little bit of a flavor that the credit's really for everybody, regardless of your size. Our first two examples we show here are a civil engineering firm and an architectural firm that are relatively small, $2.5 to $3 million in annual revenue. And they were able to generate, in the case of the civil engineer, a credit of about $16,000 through some of their design work, designing pavement, roadways, some of their site design, and that sort of thing. The architect did even better, a credit of about $30,000. Again, all revolving around the design work that they do on an everyday basis for their clients. Our last example there is a construction contractor who does a lot of design build. So again, they have the engineers and so on staff. And with about 20 million annual revenue, they generate a credit of just under $100,000. We actually do some studies for firms even much bigger than this, and we've seen credits go into the hundreds of thousands, if not millions of dollars. And remember, it is a credit. Credits at the federal tax level offset your taxes dollar for dollar. So this is real money. This is money in pocket for the firm or for the owners of that firm. So it's pretty significant and something to look into. We're going to try here in the brief time we have today to give you a pretty good overview of what it's all about. So I'll start that with just a little bit of a really quick history lesson on the credit and where the credit's been and where it is today. Typically, we say the credit will approximate about 8% of qualified expenditures. We're going to explain what qualified expenditures are as we move forward here today. And that's a baseline. We see some firms that goes even a good bit beyond the 8%. Some, depending upon their activities, are they in a growth period or maybe a little bit stagnant? It might come in a little bit less than that. But nonetheless, it becomes a pretty significant number. Now, why are we talking about the credit today? I see there were a few people that answered, we tried the credit previously, but didn't qualify. Well, there were some changes to the credit. And it's amazing how fast time flies. It seems like this was just yesterday that the rules changed, but it was the whole way back to the fall or winter of 2015 that the door really opened for people to take great advantage of the R&D tax credit. The credit itself's been around for a really long time, the whole way back to 1981. The Reagan administration put the credit in play back in the early 80s to kind of kickstart the economy. Not a whole lot different than what we're talking about today. They wanted to get more jobs for US citizens, get more innovation on US soil. And we hear all about that today, about the supply chain issues and how we have to increase production in the US. When the credit was introduced, it was only introduced as a short-term provision. It was supposed to expire after a couple of years. Well, the credit was popular, so Congress decided to keep extending it. But in that extension, they never made it a permanent part of the tax code till 2015, as I'd mentioned before. And while that uncertainty, about 35 years of uncertainty, would the credit be around for the long term, I think could be looked at as a negative, especially for the architecture and engineering field. It really was a positive because as the credit was written in the early days, I think it would have been difficult to make a case that we qualified for the credit with our design work. A lot of people still have the kind of vision that the credit is for that proverbial, scientist in a white lab coat coming up with some revolutionary new product, whether that's the latest and greatest piece of technology or a new pharmaceutical. Certainly COVID vaccines have been front and center here over the last year or two. And those things certainly did and still qualify for the credit. But as the credit continued to be extended, Congress also continued to expand its reach. So we got into the early 2000s, something called the four-part test was introduced. And Kelly's going to spend a fair amount of time on the four-part test today because it's really the four-part test that justifies that our design work qualifies for the credit. The good news is it's work that we actually get paid for by our clients, and it's expenses that we are going to incur whether we take the R&D credit or not. So in many cases, you already have a credit, you just haven't gone out and maybe captured it yet. So as we do get forward to 2015, what happened at that point is the credit had expired again at the end of 2014. We needed Congress to take action. They took their good old time in 2015. The legislation didn't pass until December 18th of 2015. But what we got was something called the Protecting Americans from Tax Hike Act, or the PATH Act. Now, this was a wide-reaching tax bill, not just specific to the R&D credit, but it did three really nice things for the R&D credit. Number one, it made the credit permanent. We no longer have to fear it's going to expire. In fact, we feel pretty secure that the credit's here to stay because especially since COVID began about 2 years ago, we've seen a number of provisions at least introduced to Congress to expand the credit even further. Now, none of them have passed yet, but the positive news on that is each and every one of those provisions had both a Republican and a Democrat co-sponsor. So we don't get a lot of bipartisan support for anything these days, but the R&D credit seems to be one that we have it. The PATH Act also introduced some nice rules for startup entities, and startup entities are defined as companies that are in their first 5 years of business and don't average more than $5 million a year in gross receipts yet. Sometimes in those startup years, as you all know if you've experienced it, is you're not real profitable early on. You're making a lot of investment and so on. Well, the credit generally goes against income taxes, which income taxes are generated from profits. But if you qualify as a startup entity, you can actually use the credit against your payroll tax liability. So that's a real nice cash boost when things are tight in the early going. The big item though was prior to 2016, if you generated the credit at the entity level, say you're an S corporation or a partnership, and pass that credit through to your owner, if that owner was subject to something called the alternative minimum tax on their personal tax return, and I won't get into all the details of AMT today, that's a whole nother topic and one you probably don't want to learn that much about, but just know that an awful lot of individuals, especially business owners, have been and continue to be subject to the alternative tax. Prior to 2016, you couldn't use the credit against it. So we might generate a real nice credit at your level, at the entity level, but our owners couldn't use it. Well, beginning in 2016, the PATH Act said, if your firm has average gross receipts of $50 million a year or less, and you pass that credit on to your owner, they can use it against both their regular tax burden and the alternative tax. So now the door was kind of wide open. So it really was in 2016 that we started to see the popularity of the credit rise. I would guess for the 51% of you who say you are using the credit, I would guess a large percentage probably weren't doing it before 2016. May have been a few of you, but probably very few. Even today, Kelly and I are on calls several times a week talking to firms who still haven't utilized the credit, don't realize that they qualify for it. And that's why we keep doing these webinars, because we want to get that word out. I don't think we'll be happy till every architecture and engineering firm that we touch is at least looking into the credit and taking advantage of it if they can. We still think it's quite underutilized. So that's kind of the history part of it. So let's start getting into what's the definition. Well, if you look at the first sentence we have here, it says a credit for the development of an unfunded, new or improved business component. Two key concepts in this sentence. The first one is unfunded. What that means primarily is that for the contract, the project you've entered into with your client, you have to be at financial risk. Well, what does that mean? Well, we've had federal tax court cases that have defined that for us. And it says very clearly that if your contract is lump sum or fixed fee, you have to deliver your product, your design for an agreed upon price, regardless of what cost you get into it. You're at risk. You have to deliver. Now, you can have a great project and make all kinds of money on that, come in way under budget. You still were at risk when you entered into the contract. So that project is definitely going to count. On the flip side, if you have a contract that is pure time and material, you get paid for every minute that goes on the timesheet. You're just passing your time through. The IRS takes the position on that your customer is at risk because they don't know what they're going to pay you. So we have to throw the pure T&M contracts out. Well, what we typically find is most customers are not giving you an open checkbook. Even if your contract is based around your cost, more often than not, there's a not to exceed involved or some kind of contract cap. And for the most part, we can make those qualify as well under the premise that you still have financial risk. Now, on those, we're going to take a hard look at the contract language and make sure it's going to be supported. And quite honestly, a lot of times when we see language we don't like, we'll make some suggestions to you if you can tweak that going forward to make a stronger case. The second part of unfunded is basically the intellectual property, the know-how. Who owns that after you've delivered it to your client? Now, we're not talking about just a set of design plans. You're going to pass them on, and they're going to go up to the contractor, whoever's going to use them to construct, the project. We're talking about the knowledge, the professional expertise. We occasionally see language, especially when you're dealing with some of the larger companies, the Coca-Colas or the Chick-fil-A's of the world, that they will put some restrictive legal language in the contract that may cause a problem. But generally, we don't see this being an issue. The knowledge you use to design that bridge over that river, you can generally use that knowledge again the next time you enter into a different project. So that's our first test. We're going to go through your project list and say, do we have to remove any because they don't meet the unfunded standard? The second part of it, business component, is kind of easy to meet. It's really saying, are you creating something new or improved? Well, with the premise, and again, we have federal tax court cases to back us up, that say that basically every design package that your firm creates is a new product. It has some type of uniqueness from any other project you've ever done. You have to look at all the variables, your customer needs, municipal regulations and restrictions, environmental concerns, wind forces, sun forces, all of that you're using your knowledge to create a new product each time you enter into a new project. So we can usually meet that standard pretty easily. So once we've done that, we know what projects we're going to look at. Now we get into this 4-part test. So I'm going to kick it over to Kelly in a minute to take over on that. But first we have our second poll question. And that was a pretty simple one, a yes, no, or not sure. And that's just asking, do you have time and expense or time and material projects that do not have a cap or a not to exceed limit? So how many of us have pure time and material contracts?
Well,
So
Tom, so I'm not sure if you're seeing this coming in. People are voting quickly or putting in their comment quickly. It looks like we're trending that about 2/3 say yes,
yeah,
that they do have projects that don't have a cap or not to exceed. We're about 25% say no, and then the other percentage looking like not sure. So there's a lot of yeses. Now, maybe we should have qualified this a little bit and said, well, what percentage?
yeah,
Maybe
yeah.
next time we do this webinar, we should add that because sometimes you do have a T&M, but maybe it's few and far between. So Kaylee, I think you can go ahead and show those results to everyone, and Tom and Kelly can move on.
Yeah, I think you make a great point, Susan, that most firms have some T&M, but what we're really interested in is where's the majority of your work. And we find with most firms, the majority of the work, there's some sort of limitation. If it's not a pure fixed fee or lump sum, there is some sort of a cap. And sometimes that varies by phases of the project as well. But it's certainly those that there is some limitation that we're going to concentrate on. So with that, we're going to move over to the 4-part test, and I'm going to hand it to Kelly.
Thanks, Tom. So kind of like Tom said, the first hurdle is, hey, identifying, if you have, these contracts and projects with a cap. And then from there, we have to make sure that, those projects satisfy this 4-part test that the IRS has set forth here. And the first part of the 4-part test is your project has to be technological in nature. And what that means is the IRS has identified what they call the hard sciences. So the project has to rely on, one of these types of sciences, the typical, the chemistry, biology, but computer science, mathematics, engineering, architectural engineering, all of them are included in this category of hard sciences. What's not included is kind of social research, marketing, those type of activities. The IRS is deemed not qualified. They're not technological in nature in the eyes of the R&D credit. So that's a pretty easier one for AE firms to kind of check the box and, hey, we satisfy this test. We're doing engineering, we're using mathematics. Sometimes we're using some computer science within our projects. So then the second test is, there has to be a process of experimentation. And I know, I think, a lot of people are like, when they first hear about this, like, oh yeah, the scientists in the labs. But what really the IRS is getting at here is the activity itself and the project, you are going to go through multiple design iterations. Not many projects from start to finish are, one option. There's no back and forth. There's no design modifications, no changes to your original idea. So most projects, you're going to go through this. You're going to test, the building structure. Maybe it's going to be made out of one material, a steel building, for example, or and realize, after some evaluations and looking at things that, oh, it might be a wooden beam structure or whatever it may be, or for bridges, you have to identify the type, size, and location. And that can change from what their original idea was. So you're going back and forth. It's that trial and error process. You're doing design modeling. You're kind of working through all the kinks in the project. So all those the fun times during a design project there, where sometimes you're scratching your head and thinking, oh, the client wants this, regulatory requirements require that. They're not meshing to weld together. How do we come up with a solution here? So it's that process of experimentation that you're going through, and kind of that last bullet point there, while, failure and cost overrun, and we'll kind of talk about this a little bit later too, in some of the tips and tricks there is, that's, while undesirable for a project standpoint, is very indicative of that process of experimentation, because you're spending all this time working through the challenges that you have to overcome. And then the third test is the elimination of uncertainty, which the two kind of go hand in hand. Honestly, what the element of uncertainty is, identifying in that project, at the beginning, identify, were you capable of doing it? What's the most appropriate method? What's the best design going to look like? What material needs to be used? Or where should this mechanical system be placed? Or where does this ductwork need to be laid out? All those questions you have at the beginning of the project, it's just identifying, hey, what what uncertainties did you have? And then the second part is working through that process of experimentation. And how did you go through and eliminate them uncertainties? Through, having maybe you were working at in a museum, and you have artifacts, and that the systems can only be placed at certain areas, and they have to be temperature controlled because whatever the artifacts might be, they have to so much moisture levels, all the things you have to work at. Had all those uncertainties, and then you work through that process. So the second and third test really kind of go hand in hand there. So it's just identifying what will this look like, what's the building structure going to be made of, or where is this bridge going to be, what length and width span is it going to be. So it's just identifying those in your project. And then the fourth test is what they call a permitted purpose. And what that is what was the purpose of your project? Why were you hired to do this? The activity must be intended to develop or improve your business component. Well, your business component is your design package. So, the purpose doesn't have to be new or revolutionary to the AE industry or, to your client. It just has to be for that specific project. So are you increasing the structural reliability of the building, or the performance of the MEP system, or the function or the quality of the work? So it's just identifying, what was your permitted purpose? What was the point of your project? Why were you hired to do it? What was that scope there? And so that's the 4-part test. 1 and 4 are typically easier to qualify and identify, and where the real crux of it is that second and third part there, and identifying those uncertainties and showing how it wasn't standard engineering. You're not just pulling something off the shelf. You're really working through that process of experimentation to get to that final design package. So then, Tom, why don't you help us identify, okay, yeah, we have these projects and we can, figure out we've got this time. How do we actually translate that to a credit?
Yeah, thanks, Kelly. So yeah, Kelly's walked us through really the crux of what we're after is identifying those qualifying activities. And the good news again in this industry is the one thing that all of you do that maybe when we would work with a manufacturer, someone like that they don't, is you keep timesheets. And we're going to talk a lot about timekeeping, but the timesheets are a great starting point. You use phases, you use tasks that identify the different things you're doing, whether that's design or schematic design or whatever. So that's a real help for us. The way that you use your Vision or Vantagepoint software can really help to enhance the credit, because what we're really after are 3 buckets of cost. So to just backtrack a little bit as to what we said, we're first going to carve your projects for the taxable year into those projects we think will qualify because of the billing terms. We certainly don't need to look at every project for the year. You would never want to go through a process like that. It would be way too time consuming. So thankfully, the IRS allows us to sample your projects, and they have some specific guidance out as to what constitutes a representative sample. So from that sample, we're going to ask you to see the contract. We're going to ask to interview whoever is most knowledgeable about that project, typically a project manager, but in smaller firms, it may be the owners, because we're really trying to hone in so that we can document kind of those trials and tribulations, the experimentation that you did, to document that. And we're trying to relate that to how much of an individual employee's time was spent in qualifying activities for the year, because the biggest and largest component of this credit is wages. It's box 1, W-2 wages. Box 1 is the federally taxable wages for each employee. So it doesn't include fringes, it doesn't include overhead and that sort of thing. So what we're really trying to gather from our sampling work is employee by employee, what percentage of their time did they spend in qualifying activities? So if we have an employee who makes $100,000 a year and 70% of their time was in qualifying activities, $70,000 of cost goes into our computation. There is a nice rule that says if that employee spends at least 80% of their time for the year in qualifying activities, we can throw out the de minimis non-qualifying and use their full wages for the year. And it includes 3 levels of research. The obvious is the person doing the design work, the engineer who's creating that package, but it also includes direct supervision. So if owners and project managers and other higher ups are at least involved in the process from a brainstorming, a review, a bouncing things off of, we would hope that they're capturing their time appropriately to the job as well, so we can use a part of their time. Also direct support of the research, which could be administrative people that are running reports, accumulating data and whatnot. So we really want to get as much coverage as we can. Again, typically in the AE space, the wages are the largest, sometimes even the only component that factors in. But there are 2 other components. The second is supplies. Now, this is supplies that are consumed or destroyed in the process. So your depreciable assets like your computers, your software, things like that, that's not going to count. That's why we don't see a lot of this in the AE space. We might see some supplies for computer model or 3D modeling if you're doing something like that. The supplies focus more typically to the manufacturer who may be, consuming steel or wood or what have you to construct a component of a new product, and they're testing that out. Supplies typically won't move the needle for an AE firm, but if you do have something, we'll certainly put them in the bucket for the calculation. The third area, I think, is an area of a little bit of confusion. It's contracted research, which more commonly you all would think of as your subcontractors. And most of you are thinking, well, yeah, we use subcontractors. That's another big number. Well, if they qualify, we can use 65% of their cost, and they give it that haircut to 65% to eliminate their profit margin to make them more comparable to what you would pay an employee if they were on staff. However, you have to pass 2 tests for the subcontractor. Number 1, what they're doing for you has to qualify under the 4-part test as well. So they can't just be doing testing work or something like that. In a civil engineering firm, if you're subcontracting out all your surveying is really not design. That's more of a testing nature, so that won't qualify. But more importantly is you have to look at your contract with the sub. So typically, if your client's paying you on a fixed fee basis, you're probably not going to give your sub a T&M contract and let them run up their cost at their will. So if you do, you can use it because you're at risk with them. But if that contract with them is also fixed fee, then they're really at risk, and they're going to want to use that cost for their own credit. So this is put in place to prevent double dipping, that you're not using their cost in your credit and they're taking a credit on their own. So we'll occasionally see some nice numbers coming through contracted research, but for the most part, we're really focusing on the labor and the wages. And again, as we said, that's why Vision and Vantagepoint kind of line up so nicely for accumulating that, and we're going to give you some hints on how to do it even better. So once we have that, here's where that 8% comes in, that the credit's generally going to be about 8% of those costs. Now, there's 2 ways to calculate the credit. One called the regular credit, one called the alternative simplified credit. We honestly don't see a lot of firms using the regular credit because, as you can see on the screen, you have to generate a base period, and that base period has to be 1984 to 1988, or if you weren't in existence that long ago, your first 5 years in business. So unless you're a relatively new firm, you probably aren't going to have reliable data from the first 5 years in business. If you do, great, we'll follow that method. But I think probably well over 90% of the credits that we do each year probably use the alternative simplified credit because the information is more readily available. And the alternative simplified credit merely says, here's an algebraic equation that says your credit is your current year qualified cost, what we talked about on the previous slide, minus 50% of the average for the prior 3 years, with that result being multiplied by 14%. So let me use easy math to illustrate that, hopefully easy math. to show you what a credit might look like. So say we're a relatively small firm and we do our work and we're doing a credit for you for your 2021 tax year that just ended. Well, if you've never done the credit before, we have to establish that base period. So we have to look at 2018, 19, and 20 as well. And we do that work, and lo and behold, for every one of those 4 years, we find exactly $1 million of qualifying cost. Obviously, it would never come out exactly to those numbers, but for the ease of math, $1 million each of the 4 years. Well, obviously, the average of the base period is $1 million. 50% of that's $500,000. Subtract $500,000 from my current year $1 million, I get $500,000. The credit rate's 14%. 500,000 times 14% gives me a credit of $70,000. Pretty nice tax savings if we're a $5, $6, $7 million firm that our owner just cut his federal tax bill by $70,000. Well, if you play with some numbers in that formula, you can see that if your costs are going up, you're growing, there's going to be more of a spread from the current year to the prior years, and your credit will be even higher. If you're kind of calculating along at home and you followed what I said, 70,000 divided by $1 million, that's only 7%. And you're going to say, well, you told me 8%. Well, most firms are growing, so that spread is going to be a little larger on that. Now, in 2020, we saw some firms have a little bit of a pullback, obviously with COVID. In 2020 and 21, we also saw some firms take advantage of the employer retention tax credit, which is another topic for another day, but certainly another powerful tax savings tool. Well, the employee retention tax credit was based on labor too, so we couldn't double dip with that. So in 2020 and 2021, we did see some firms have a little bit of a pullback on their credit, but remember, if their qualified expenditures went down for a reason like that in those years, they're going to float into your base period for the next 3 years, and that's going to help you as you have your recovery because that spread's going to be bigger. So it's maybe just a temporary dip that'll pay itself back. And I know that gets into a little bit of complicated math and maybe beyond what we all want to try to wrap our arms around today, but that's something we'd be happy to run some, pro forma numbers for you to illustrate that if you'd be interested in getting an idea, maybe what your credit would look like. So that's kind of the mechanics of the credit. What we'd like to jump into next is just talking about ways that maybe you can maximize your credit, and then some specific things about timekeeping. So with that, I'm going to kick it back over to Kelly once again.
Thanks, Tom. So yes, the credit's all great, and looking at it, so you think, okay, we have this potential credit. What are ways we can do to help make it even better? Internally, what can we do to enhance our credit? There are, kind of multiple ways to do that. And then one way is contract language. So like you heard Tom say, one of the things we have to look at is, your fee terms as well as who owns the rights to the work. So, making contracts that, if the contract says T&M, but, in real practice, there is a limit, it's just not written down, make sure it's in the contract then. If the IRS would look at it, they're going to look at what's in the contract, not what was just standard practice, as well as looking at the rights to the work produced. So we'll see a lot of times, in the copyright section or the intellectual property section, making sure that, you retain the intellectual property rights to the works produced, or you guys retain the rights to the copyrights for the work as well. That is one key area where we see sometimes that, that's those types of rights are given up to your client. Now we understand sometimes that's always not wiggle room there for you to change with your client, but that's something to watch out for, that if you do have wiggle room, to make sure that's in your favor. Typically, contracts where the intellectual property rights and copyrights are not with you, they are not allowed to be included. And then, documentation is also critical for the study, being able to support and prove, hey, this is what we did and, why we claimed the credit. So proper documentation can include, keeping records. And, that's in addition to your design packages and the work you've done, meeting notes, saving them into your files and kind of documenting that process that you went through and the alternatives that you had for the study, and working through that, having those documents, organized in a folder in your system. And kind of what key we're going to keep talking about is timekeeping. One great benefit that AE firms have to help with documentation and creating that nexus between the project and the qualifying cost is record keeping and the timekeeping with how you guys have your vision and vantage points set up. Before we kind of talk more about that, we do have an additional polling question. And the poll is, what system are you using today? Are you in Vision, are you in Vantage Point, or are you in a different system? So I'll give you a minute to answer that, and then we'll talk about some best practices in the Vision and Vantage Point of recording time and how to maximize that. And not only does it benefit R&D, but it also benefits other areas of your business as well.
So Kelly, again, people kind of jumping in and voting. We got, it looks like about 2/3 right now are saying Vision, third Vantage Point, and then we have a very small percentage that are using something else. So maybe they're here just kind of learning about what's possible, or maybe they're getting ready to move into Vantage Point and they're just trying to get their feet wet with what's possible. So I think our numbers have stayed pretty steady. So there are the results. So 2/3, a third, and a little bit.
Great. So Vision and Vantage Point, which makes things kind of nice for timekeeping. You're setting up projects and hopefully you're setting up phases and such, which we'll get into, is a really great tool to use to document and be able to pull out qualifying costs for the R&D. Now, what's hinged upon that is if everybody enters their time into the system and how they enter it. That is a real big driving factor here. So we do have one more polling question, because we see this a lot sometimes, is not all owners or principals enter their time. So they make staff do it, but not all owners or higher levels up in the company do charge their time. So we are curious to see, do you charge your time just like everybody else? Sometimes we do it, every once in a while, or no, we just plug in 40 hours a week for the overhead labor code, or no, they just tell us what is billable hours to add to the projects when invoicing, or never. Are you kidding me? We don't enter our time. And trust me, I completely understand the nuisance of time entering. So.
Yeah, so let's see how this one floats out, because this is interesting. And in all my years of working with firms, it would blow my mind when I would have clients say, oh yeah, our principals maybe give me their time once every 6 months, or when we're doing billing, they say, oh, add 2 hours here or add an hour here. So very curious. So has this been launched? I don't know, Kaylee. Let's see. Let me just go ahead and launch it. There we go. Now you can all start answering. We had a little glitch there. I guess it gave you time to really think about your answer. And I'm really pleased with what I'm seeing so far. I don't know, Kelly and Tom, if you're seeing this kind of come through as people are voting, but we have almost 85 to 90% saying yes, just like everyone else. And so way to go, leading by example, right? You want your employees to enter their time regularly and daily, you got to do it yourself. So go ahead. Let's see, we've got some issues going on with Kaylee. Kaylee, are you able to kind of close that out, or do you want me to do that for you? I'll go ahead and take care of that. Oh, she got it. All right, so there are the answers, guys. So proud of you all. I don't know about that 6%, 2%, and 1%. So we got about 10% of you we're a little worried about, but you'll improve. We know you will. After you see what's possible, have at it.
Well, thank you for hearing us with that, with the response there. We're definitely curious to see, what type of our audience is doing there. So part of the best practices is everyone should record their time, including the owners, or higher level ups. Just enter it to the project, and making sure that, everyone in the company is consistent in how they're entering their time. You're picking the right phase, and then if you have tasks or activity levels, drilling down to that, making sure your time is entered into those correct phases and tasks, as well as not plugging it to admin or project management. I know it's easy, but you're bearing qualifying costs that make it hard to pull out later, or justify later as well, depending on how you're charging it. And it kind of helps from multiple ways. You're not just not helping with R&D, but there's other business practices that we'll talk about in a minute that's going to help with that. So we're saying, have distinct phases on projects, have them line up with the life cycle of the project, whether it's conceptual design or design development, having them broken out, not lumped all together, SD to CA all in one phase, having them each distinctly broken out. Try to, if you can, have a standardized phase if possible, throughout the company. For each project you have, 5 lists of phases or wherever it may be. And, if you do have to have some additional or one-off phases for something specific, try not just to put, WO number 1 for work order number 1, or, kind of abbreviated, try to have a little bit more in the description there to identify what was it. Was it just additional construction administration time, or, were you doing redesign work or whatever it may be? And then, kind of hitting it home there, charging the phase that you actually worked on. I know sometimes we get to talks with individuals, and, the CD phase, or, whatever the phase you're working on, you're kind of going over the additional budget. So you're just going to start charging time to the next phase. And hopefully then by the end of the project, it all evens out. That's, while good and dandy for billing purposes, sometimes it kind of can hurt you sometimes on the back end for other things. And kind of number 5 there is, if you're over budget, don't dump it somewhere else. Don't put it into an admin code, or a project management code. If you need to have an additional code set up, for additional design overrun or something like that, at least you'll be able to identify, hey, this was design time, or qualifying time there, and it's not buried in administration. And in the next slide here, we have some examples, and I'm not going to read through them all. You'll have the slides there to pull. Just some standard phases and to use, and for project setups, if you're looking into ways to help your get your system set up. Here's some examples of ones we've seen that are good examples of ones to use that break out the different phases and have distinctly identified what's going on there. So while having distinct phases and having your time charged to appropriate codes, and actually charging your time is really great for R&D purposes. You're documenting your qualifying time, you're creating that nexus, you're creating that good documentation to support it in case it was ever questioned. There are also other benefits for this too as well. Full reporting on the time spent on projects helps overall project management for the firm. You can see, hey, we've been quoting these design projects. Maybe it's a apartment complexes, that's what you're focusing on as a firm, and you've been quoting, you think they're going to take this amount of labor costs. Well, once time's entered and you can really look at it, if everybody's doing it appropriately, you can kind of see, oh, hey, yeah, we're doing really good on our quotes, or no, we're going way over, and why. And that helps you drill down that too. So it helps our project management, and you'll be able to pull reports from your system and have consistent reporting. And not know, oh, hey, this is going to be skewed because of this, or this isn't truly accurate because these people don't put their time in. So that really helps for those factors as well. It also assists with employee matters as well. If there's some employee issues, having time charged and be able to see what's going on there, helps with that. But it also helps too, like I said, with the over budget, overrun. Maybe you can identify things. Hey, we spent, 10 more hours in the design development phase than we projected. And when you're drilling down and looking at it, oh, it's because the client asked us to do X, Y, and Z that wasn't in our original scope of work. Well, hey, you might be able to bill extra for it. So that helps identify those as well. So, proper timekeeping, setting up standard phases and such is perfect for R&D, but it also helps benefit this in other areas of your business as well. So it's not just a one-use thing there. And then the next slide here, the components for R&D extraction, for what we typically look at, and why the phases and charging time is so important is when we're looking to calculate credits, we're going to pull project labor reports. And so, we are looking at, being able to filter for your fixed fee lump sum, not to exceed projects, having to be able to pull out specific, phases and naming culture, is really great. We can create templates, and that helps, future going forward, easy to run, to pull out data, and helps us segregate, qualifying activities versus non-qualifying activities like construction administration and such. So that's, really why we stress keeping your time and trying to do it consistent and having things broken out appropriately. So now I'm going to pass it over to Susan, and she can help with more of the mechanics in the system there.
Awesome. Thank you so much, Kelly. All right, let me kind of switch gears here. So I'm going to stay out of PowerPoint just for sake of time. You all have screenshots of what I'm going to show in the PowerPoint. So I know you guys often like to see it better in the system live. So I have both my Vision and Vantagepoint systems up. Kelly or Tom, can you guys just confirm that you're able to see that? I want to make sure I got the right screen up.
Yes.
You see a Vantage screen? Oh, perfect. Perfect. All right, fantastic. So what I've done here is, Kelly and Tom both have indicated tracking your overall contract type or billing type is very beneficial in this, because then you can use that for the test and to isolate that information. Granted, that's kind of in your billing terms, but a lot of firms create a user-defined field that they can put either at the project level, or you can even go through your work breakdown structure if you do have your contracts vary phase by phase, where one might be a not to exceed and another might be fixed fee and open time material. So here you can see on my Vision screen, I do have a user-defined field, and I just put in several options in here, which allows me to tag onto that project what contract type that is. And if we look behind here in my Vantagepoint screen, you will also see that I created a similar type field here in Vantagepoint. So for those of you in Vision, you know that to create a user-defined field, you have to do that down in configuration. Not everybody has access to do these types of things, but that's where that would be done in Vision. And in here in the Vantagepoint, it's actually a lot easier, because you can actually go to your design screen and actually add the user-defined field while you're in the hub itself. You don't have to go out to a separate area and then back and forth. So here I'm in Vantagepoint, I'm on that accounting tab. You see that field here. If I wanted to add another field, I can easily use the add field button and then fill out the appropriate information and then move it to where I want it to be on that tab. So, great way to kind of add those fields to be able to track that on the system and tag that out to those projects. So when, folks like Kelly and Tom come in and want to get that sampling, you're already prepared. You've got your projects tagged appropriately. The next thing that we want to look at then is the fact that you're going to be running reports. So again, I'm going to flip over here to my Vision system, and I'm going to look at project reporting. So we've been specifically talking about the fact that labor is the majority of the credit value. So what I've done here, I have created one for the user group today, but it's literally just the labor detail report, where I've gone into the labor report, and within the options, I've selected the various criteria that we want to grab in order to get the total hours. And of course, my demo is going to hang up here, but the total hours and the value, or the dollar value, the key thing in here to align with W-2 is that you want to make sure you're picking cost, right? So you're going to select cost in here. You're going to pick your period range. I apologize, my demo, we live in the past in our demo databases. So I picked a prior period. My sorting and grouping aligns with my project work breakdown structure. So yours might be a bit different, but in my demo database and these samples, we have standardized our phases, as Kelly has indicated, to kind of help extract this data. And then the columns that I've selected are just very basic: total hours and total cost amount. So when I run that report, I get a report that looks like the top part here, right? Very simple and consolidated. Now, if you wanted to include more details, like the actual labor transactions and your people, you certainly can do that. I've just collapsed mine down, so I didn't see all that detail, but that can certainly be part of the selection and the options. So up here, I have this broken down to the projects that I've selected, and I'll hit on that in a minute. And then the breakdown structure of my projects and my phases, you can see they're standardized. When I set up this report to run this report, I am filtering it based on projects that have a cap or are fee-based. So I am excluding any of those open-ended time and expense ones. So these are the only few projects that I have in that year that meet that criteria. Now, the nice thing is that if you are in Deltek's cloud, or if you have the full version of SQL, you can easily extract this data out into Excel, so that then whoever's doing the analysis for you, whether it's our team or someone else, you'll have a nice, clean, concise report for them to work with for their analysis. And the way that you do that is up here in the top, and it's the same in Vision and Vantagepoint. I'll show you Vantagepoint in a moment. There is a magnifying glass. A magnifying glass opens this box here down at the bottom, and this has various display criteria based on how you've configured your options. And all you're going to do is you're going to go through here, and sometimes it's a little bit cryptic, so sometimes a little trial and error. You'll select the levels. So here I'm saying that I want to see my project number, then I'm wanting to see my phase, and then I'm looking at the hours and the amounts based on phase. So it's very collapsed down. Once I select those items, I hit my search button, and on the results tab, it pulls back to me a very collapsed version of the report above based on that criteria. And then in Vision, you have to use this little arrow to drop down and select Export to Excel. In Vantagepoint, it's a little bit different. I'll show you that in a minute. So as you can see here, it plunked that right into Excel, and now they can kind of run their calculations, do their testing to see how much you qualify for. If I go back to my Vantagepoint system, which I have here, again, same thought process, right? I have my labor detail report. I've configured it similarly here, where I have the project and the phase, the hours. Again, in my options, I'm telling it to report based on costs. And then when I run that report, I get a report that looks similar to the one that I had in my Vision database, and a little bit different data. Magnifying glass at the top opens up your selection criteria at the bottom. I'll make that a little bit bigger for you. So in the selection criteria, again, you're going to check the boxes next to the items that you want. In Vantagepoint, it's a little different. You do show results, and it toggles you to the results screen, which is going to arrow out on me because I had this up too long. Once it populates that grid that looked very similar to Vision, then you'll notice here on the far right-hand side is your ability to export. So it's very, very similar in the functionality between the two. Once you get to the report itself, magnifying glass to select, the export is just in a different place. It doesn't have two tabs at the bottom. It has your results versus your criteria. There are other things that you can do within this selection where you can get a little fancier if you want to use some filtering and filter it out and then say, you know, only show me certain phases, or you're using that contract type and you're filtering to only show you that through this criteria as opposed to before you run the report. But this is extremely powerful when it comes to grabbing the labor data for the R&D tax credit. So with that, we are at the top of our hour. I just want to say again, a huge thank you to both Tom and Kelly. I was chuckling here as you guys were talking. I feel like you guys must have been architects or engineers in a previous life, because your depth, not only of, you know, accounting, right? You guys are CPAs, but your understanding of the industry really shines as you're presenting and talking through that, like, you know, your alter ego is an architect or an engineer. And that's one thing, you know, with Stand On Us is we are very focused on the AEC space to kind of help you guys, and you guys are the epitome of that. You showed that to us all today. So without further ado, again, we're a minute over. Please fill out the survey when you exit the meeting. I really appreciate it. Again, thank you, and thank you, Kaylee, for keeping us all on the straight and narrow, and we'll see you again in April. Thank you, everyone.